Investing for Beginners, Lesson 7, Setting Up a Diversified Portfolio. How to diversify. When we talk about diversification, we need to check the different sectors or industries that make up the stock market. There are 9 different sectors and variable amounts of industries in each sector. A good rule of thumb is buy stocks in an industry that you either have experience or is easy for you to understand. For example, financial stocks can be more difficult to understand for someone not in the banking business, and they might be more knowledgeable of products such as tools or building materials sold at a company such as Home Depot. Invest in companies that you purchase goods is another good idea. Another example of good companies are Walmart and McDonald's, because many people purchase goods at Walmart and also buy fast food at McDonald's. Set investment goals. When setting up a well-diversified portfolio, an investor needs to set investment goals. Growth and dividend-paying stocks are very important when selecting your stocks for diversification. An investor's goal should be to attain average growth in stock prices and dividends income of 14.9% compounded annually. At this rate, an investor will double the value of their stock investments every 5 years. A lower increase of 8 to 10% is still an excellent return, but you must set goals on all of your stocks. Accumulating more shares for a larger payout is another reason why you should set your goal to build your shares over time. The more shares you have, the larger the profits and the larger the dividend check you will receive each quarter. What qualifies a portfolio to be diversified? A qualified portfolio is one that is invested in stocks that has diversification. Investors need to understand the meaning of diversification. The definition of diversification is to reduce risk in a variety of stocks owned. An investor wants to be diversified in stocks so their portfolio has stability. This is done by buying stocks in different sectors or industries. This can also be done by buying stocks by company size. As part of the diversification process, we recommend including big, medium, and small size companies in your portfolio, which is determined by the annual sales. Big companies have annual sales of $4 billion or more, which tends to have a more predictable rate of growth and offers more resistance to price decline during a down market. They grow at a rate of 5 to 7%. Medium-sized companies with annual sales of $400 million to $3 billion provide stability, which aim for a growth potential of 7 to 12%. On the other hand, small companies have annual sales of $400 million or less, are able to achieve more accelerated growth, but tend to drop in price quicker in a down market. Invest equal amounts of money into 3 different size companies helps to diversify your portfolio as well as grow your portfolio over time. What to look for in a stock to build a diversified portfolio. In this stock investing course, we have mentioned how important it is to buy stocks that have strong cash flow, low debt, increasing sales and earnings each year. These stocks always have very good management. Remember, good stocks do not always go up in price. There are days when one of the stocks will drop in price due to some news that is announced, which lowers the whole sector or industry. If your portfolio is invested in another sector or industry which receives good news, it will go up in price. The stock that goes up offsets a drop in a stock owned that has lowered in price due to bad news. This is why diversification is so important. Create a wish list when buying stocks to set up your diversified portfolio. You should always have a wish list of companies to purchase. Set a desired price for your stocks. This way, when the stock market corrects or drops due to bad news, you can purchase your stocks. Wait for a buying opportunity. For example, such as when the government debt became too high in 2012, which required the government to vote on raising the debt ceiling, the market dropped, creating a buying opportunity for stocks. Buy what stocks you think are the best in a sector. Do not choose two stocks in the same sector which are competitors. This isn't the best strategy because it is counterintuitive. For example, choose one or the other, such as Pepsi or Coke, Lowe's or Home Depot. How many stocks should a new investor have in a portfolio? A good number of stocks to start out with are 5. Another good rule of thumb is only invest in the number of stocks that can be monitored each quarter when earnings are released and annually when the annual report is available for you to review. Only own as many stocks as you can watch carefully. Too many stocks in a stock portfolio are too difficult to keep up with the company's information. A sample of a diversified portfolio. Here is a diversified portfolio that shows 5 stocks in separate sectors. Number 1, Home Depot, which is in the home improvement sector. Number 2, ExxonMobil, which is in the basic material, oil, and gas sector. Number 3, Johnson & Johnson, which is in the healthcare sector. Number 4 is PepsiCo, which is in the beverage and soft drink sector. And number 5 is Intel, which is in the technology sector. Summary. We check the diversification of a portfolio by reviewing the 3 important steps. 1 is we check the diversification of the portfolio by sector and by industry. 2 is we check the diversification by size of the companies. And 3 is we confirm companies' growth potentials. Thank you for participating in our Setting Up a Diversified Portfolio. Please continue to the next video.